Good afternoon and welcome to another quarterly presentation by Peridot Family Law addressing issues that you need to know if you're going through a family law matter or a divorce. Peridot Family Law is a full-service family law firm located in Boston, Massachusetts. We strive to help our family law clients get through the family law process in the best way possible. We provide thorough and experienced legal services coupled with a holistic and empathic approach to solving our clients' family law needs, including divorce litigation, mediation, and collaborative law. Please know that we are recording this presentation, and we're going to use it as a resource on Peridot Family Law's YouTube channel. So if you don't want your image or voice captured in the presentation, you may wish to simply put your question into the chat, and I can read them. If you don't want your name to be visible to other participants, then please rename yourself through the Zoom app. So today's program, and I'm just gonna pull up our presentation. Okay. Can you see that? Hopefully. All right. I think it's, whoops. There we go. All right. So for today's presentation, I have the pleasure of introducing you to Jeff Weiner. And Jeff Weiner is the president of HKM Associates, and he has many years of experience in the financial services industry, bringing extensive knowledge and experience to all areas of financial services, specializing in life, health, long-term care and disability, income insurance, and he was previously employed with Phoenix Life Insurance Company and was recognized as one of the firm's top financial representatives, receiving the firm's Rookie of the Year award in his first year, 1982. He was a President's Club qualifier 18 times and was a two-time recipient of the Centurion Award, 1995 and 1996. He was a recipient of both the Stephen Berger Award and the Laurel Wreath Award, 1986. And in addition, Jeff is a qualifying member of the $1 Million Roundtable. Jeff holds a Bachelor of Arts degree in political science from SUNY Albany and a paralegal certificate in benefits and pensions from Adelphi University. Welcome, Jeff.
Thank you very much.
All right, so let's see if I can get this going here. So this was a little bit about Jeff. All right, so let's jump right into this. People have lots of questions. We were just talking about this before we hit the record button. But what are some of the issues that can happen when somebody's going through a divorce if they have health insurance through their spouse who's they're covered with?
Sure. So just a little background about myself. Jeff Weiner, HKM Associates. I've been in business for 43 years. And we do MRIs and CAT scans, but on insurance policies. So we show people what they don't know. We spend a lot of our time on education because in the areas that we work in, which are benefits for companies, everything from international tech startups to hundreds of employees, and on life insurance. And so, so what we're focusing in on today is if you have the unfortunate situation of going through a divorce, how is your health insurance affected? What can you do? What can't you do? And then we're going to talk a little bit about life insurance and some of the things that you should know about your life insurance policies that you may not know. So as far as, health insurance goes, there are different types of plans, and you hear EPO and PPO and HSA and HRA and all these terms. So we're going to kind of go over a little bit of that. And then we're going to talk about like what happens with your plans if you're going through a divorce. So an EPO is an in-network only plan where you do not need referrals, and it's typically a plan, whether it's Blue Cross or Aetna or Oxford or United Healthcare, doesn't really matter. But an EPO is an employer provided organization where you got to go to the doctors in network. Typically you pay a copay, for the plan. And then there's an HMO, which is same in-network only type of plan, but typically you do need referrals. So if you need to go to a specialist, you need the referral, and you would go to your primary care doctor first. But in today's world, HMOs aren't like they used to be years ago. It really focuses in on care, and you don't need a referral. I mean, you need a referral, but you don't have to actually go to your doctor. They do it electronically. So HMOs have, while years ago were very unpopular, have become more popular now. Then there's something called a PPO, which gives you in-network and out-of-network benefits. And people think, oh, well, I have to have a PPO because I want to be able to go to that doctor. Well, in most cases, if doctors take insurance, they're going to take the Blue Cross of Massachusetts is a big player. United Healthcare is a big player. So if they take insurance, they're going to take the carriers. The advantage of a PPO is that you can get coverage for out of network, meaning a doctor that doesn't take insurance. However, we do a lot more work with EPOs because when you have a PPO, it's a separate deductible you have to meet. It's also a much higher premium typically. So when you're looking at your health insurance coverage as to whether you want an EPO or a PPO, you really have to say, okay, how often do I go to out-of-network doctors? Because the hospitals, for the most part, are all in the networks of the major carriers. Whether it's a Mass General or whatever the hospital might be, they're typically in network. So when you do an analysis on an EPO versus a PPO, you have to really figure out how much do I go out of network? Is it worth spending the extra monthly premium? Plus, you got to meet a deductible too. So if you go to one or two doctors that don't take insurance, in most cases, it makes sense to self-insure, buy an EPO, and not have to deal with the out-of-network deductibles and, more importantly, the out-of-pocket expense of a PPO.
So, Jeff, sometimes I'll have a client who will have a spouse that's moving out of state. How does that impact coverage after a divorce, assuming that the coverage continues post-divorce?
Sure. Well, it really depends on the carrier. So like Blue Cross of Massachusetts is what's called a regional carrier. Great in Massachusetts doesn't do you any good if you're in New York or Philly or California. So, but there are carriers like United Healthcare, which owns Oxford in New York, Aetna. They are both national carriers. So it really doesn't matter. You don't really need a PPO. Well, you might need a PPO if you have Blue Cross of Massachusetts. If you have United Healthcare, if you have Aetna, you don't really need a PPO because those are national players. There's doctors all over the country, so it doesn't matter where you move because, we had a group recently that had a PPO with Blue Cross because the guy was seeing a cancer doctor in New York. Well, we moved them to United Healthcare. Now the doctor's in network. So he doesn't really need a PPO anymore because all of his doctors were in network because it was a national player.
How can someone who's going through a divorce find out if they really are, if their spouse really can cover them after the divorce? I mean, most people say, oh, no, there's no coverage. What tips do you suggest for the person to pursue?
Yeah, again, it depends on the carrier as far as, is that going to do you any good having their coverage or continuing their coverage?
Mm-hmm.
And, you have two options when you get divorced. You can go on COBRA, which is a federal law that has to be offered to you if you get divorced. Okay. And typically COBRA will last depending on the state, but COBRA in most states is 18 months. So it will give you coverage at the same price that the company is that you're paying and you'll have the same coverage, same price, same benefits, same doctors for 18 months. And then with some of the carriers, after the 18th month expires, you perhaps could buy an individual plan from that same carrier after the 18 months expire. Now, the disadvantage of Cobra, if it's a high-end plan, it might be very expensive. If it's a lower-end plan, maybe not, because don't forget, when you go on Cobra, there's no company subsidized money coming in. So the premium that may be under your present plan, the employer is paying a large portion of it. Well, once you go on Cobra, they pay nothing of it. It's all your costs. And so the Blue Cross or the United Healthcare PPO plan may be great coverage, but may not be what you necessarily need, or more importantly, what you could possibly afford, because you're paying the full premium. In which case, then you can go on individual plans like the Mass Connector, and they have a number of individual plans can be purchased on an individual basis. And even though there's an open enrollment period for the Mass Connector, that doesn't apply, because getting divorced is what's called a
Qualifying.
qualifying event, change in lifestyle.
Mm-hmm.
So it opens up the opportunity for you to, if you choose to go on the individual exchange, it gives you an opportunity to do that. But be very careful, because if you take Cobra and then say, this is way too expensive, and you choose to cancel Cobra, that is not a qualifying event. So when you're making your decisions as far as what coverage you're going to get, you can't take Cobra and then in the middle of Cobra say, okay, now I want to cancel Cobra. Now I want to go on the exchange. You can only do the exchange during open enrollment. It's not a qualifying event if you take Cobra, can't afford it, and now want to go on an individual plan. Unless it's open enrollment, you cannot do that.
Right. Some plans are they're self-insured. Can you talk a little bit about that and how they're different?
Sure. So, some of the plans that are self-insured are not mandated by state law. So if it's a self-insured plan, the coverage may be different. Cobra may not even be available to you under a self-insured plan, because it's not mandated by the individual state regulations. So you have to be careful. Now, typically the self-insured companies are very large companies that do self-insurance. Most small businesses don't do self-insurance. Some do, but you have to just be careful with the self-insured plan as to what's the rules if there's a divorce. Do they offer Cobra? Because again, it's not mandated by Massachusetts law, New York law. It's kind of a free-for-all open, as far as rules go. They can not cover maternity. They can not cover chiropractors. When you have self-insured, you're kind of the company is kind of designing their own plan so they can limit certain coverages. So if you have self-insurance, you're covered by a self-insured plan now, you got to just really be careful as to what's covered, what's not covered.
So one of the things we'll ask for when we're trying to confirm whether or not there is coverage post-divorce is a plan summary. So are there any other documents? Well, first of all, can you explain what a plan summary is? And can you let
Yes,
us know, are there other documents we should be looking for to confirm?
sure. The plan summary is really the best one. It's called a summary plan description. And it really gives in-depth detail. You don't want a highlight sheet of the benefits like they do in an open enrollment meeting, because that kind of covers a few things, but doesn't really get into the nitty-gritty. The summary plan description, which is something that you can request as an employee, really goes into the details of our chiropractic covered, a hospitalization, what's the copay, home care, a lot of issues that are typically not covered in an open enrollment meeting. that you don't know if it's covered or how it's covered or what prescriptions are covered and whether they're a tier 1 or tier 2 or tier 3 drug. That's all laid out in depth with a summary plan description, because that really is a contract that the insurance company provides to employees to really give an in-depth detail of what's covered, what's not covered, how it's covered. You need pre-authorization for certain prescriptions, things like that. That's all covered in the summary plan description. And that's something that is critical, especially if you're deciding whether to keep COBRA or not keep COBRA, whether to go in individual plans or, what you're doing. That's the key document. There's really not anything else that's better than that or needed besides that, because that really gives you an in-depth detail study.
Okay. So let's go to the next slide, and this has to do with deductibles. So before we jump to deductibles, can you talk about sometimes what can happen when, well, what I've seen frequently happen, where if someone does have coverage through their spouse and they're divorced, the spouse who's getting that coverage, that was maybe not the employee spouse, the cost of their coverage can go up. Can you talk about that?
Sure. So when you have coverage, it's not that the cost goes up, it's just because an employer was covering a portion of the premium, and now if you're going on COBRA, you're paying the full single rate of what the company would have paid. So the rates don't go up if you go on COBRA. It's just your responsibility. I mean, theoretically, I guess your rates do go up because the employer is not paying any portion of it anymore. So the cost doesn't change, but your responsibility does.
Right. But in those cases where, so for example, if we, I'm representing someone and they're getting their health insurance through their spouse, what I understand is that once the divorce is final, previously they were under a family plan. The insurance company now says, well, you guys, husband and wife, are no longer a family. So we'll provide the wife with coverage, but we're going to gross up the husband's salary to pay for that difference of the coverage. Do you know can you say a little bit about that?
Yeah, I mean, when you're getting divorced, and you go to different types of different tier structures, then the premium can change if you have a husband-wife coverage versus full family coverage. Actually, the cost should go down if you have family coverage and then you're going to husband-wife coverage. The cost actually goes down. But as far as what the ex-spouse is going to pay goes up, because again, it's based on subsidy and what they need to coverage.
Right.
What they need to cover.
And how it usually shows up, in our context is, the spouse who's working, who's providing the coverage, will end up paying more taxes. And so there's usually like an offset between the parties to address that issue. And that's something that we figure out, the lawyers kind of also give the clients sort of a heads up about that so they can make decisions.
Yeah, and you also have to be concerned if you're under your spouse's plan and now you decide that you don't want to continue COBRA and you want to go on an individual plan. Well, if you've had claims, there's no credit for deductibles. So if you're covered now, it's January, okay, and now you have a bunch of claims, and you get divorced, then March you go on an individual plan. Well, your deductible starts all over again. So whatever you had and your deductible, and now you're getting reimbursed at a better rate because you've met your deductible. Now you got a new plan. Well, your deductible starts all over again. So it could cost you more out of pocket as far as claims go. So again, when you're determining whether you should keep COBRA or go on an individual plan, it really is an individual situation based on What's my medical history? Do I have a lot of claims? Have I had a lot of claims already? Am I at the point where I'm going to get 100% reimbursement, where if I now go to a new plan and it's a $5,000 deductible, well, that's $5,000 more I got to lay out because I'm starting a new plan and the deductible starts all over again. And there are two things with health insurance. There are copays and there are deductibles.
So let's talk about those.
Yeah, copay is every time I go see a doctor, I pay $20, $30, $40, $50. Copays you pay each time you go to see a doctor. A deductible is something that's typically either plan year or calendar year, but once you meet your deductible, then you're done. Now, there is something called co-insurance, which is additional money that you could lay out of pocket as well. But, so there's two components to health insurance. Copay is routine stuff. I go to the doctor for a for a blood test, an x-ray, a lab. I have a prescription. Those are typically copays. Okay, especially if you have a gold, silver, or bronze plan, and I'll talk a couple of seconds about what that means.
Mm-hmm.
And deductibles are additional money you're going to lay out of your pocket, where you have hospital, surgical, major testing, things like that. That's what a deductible is. And a deductible is once you've met your deductible, then you're typically good for the year, except if you have one plan and now you switch to a different plan.
So when you say if you have one plan and then you switch to a different plan, in situations where you have, like, the parties were on a family plan, then they divorce, and then the non-working spouse is not part of the family anymore, they're still under the same plan. It's just
Correct.
that it's just
Yeah,
that
correct.
Go
The
ahead, I'm sorry.
deductible, sorry. The deductible wouldn't start over just because you're getting divorced if you're covered under the same plan. But if you choose not to continue that plan and want to go on an individual plan because of the cost involved, then your deductible would start all over again. Because if you get divorced and you're still on the same plan under COBRA, then that's fine. Then your deductible would not start all over again, and it would be the same, same deductible, same plan that would continue. But if you go on to an individual plan, that's when your deductible starts all over again.
All right, so let's go to the next.
And then there's also just a couple of things that ways that you can save money on your health insurance that you may not know about. So
Let's
it's
talk about
kind of tips the ways you can save money. So there's 5 ways you can save money with health insurance that you may not know about. So the first one, you go for a copay service, blood test, x-ray, lab, because annual stuff is covered for free. Annual checkups, mammograms, those are all covered under wellness for free. But a tip about that, make sure when you go to see your doctor for your annual checkup that they know it's an annual checkup. Don't go when I have a cold, I'm seeing the doctor, and say to the doctor, okay, listen, while I'm here, let's just do my checkup. Because then you're going to get charged for it versus an annual checkup, which is free. So you got to make sure that they know it's for an annual checkup. But there's 5 other things. So the first one is copays. So you pay your copay you go to the doctor for a flu. All right, you pay your copay. Then you get these really annoying bills for like $27, $42, small amounts of money above the copay. Well, don't pay those. Call the hospital, the doctor, and the lab. Say, wait a minute, I paid my copay. Why am I getting billed $27 above that? And then the bill will go away. Because by contract, I'm not an attorney, but by contract, copayment is payment in full. You're not supposed to get billed 10 cents above a copay for a copay service. The hospitals, the doctors, and labs will do it because everybody pays it. Be a great class action lawsuit. Second one, You go to an in-network hospital and get a bill from an out-of-network doctor that you didn't pick. And they call you and say, hey, your insurance company didn't pay me. You have to. You
Yeah.
don't. You have to call your insurance company, tell them you want to file an appeal. It's a one-page form. And then the insurance company will call the out-of-network doctor and work out a fee. So if you go to an in-network hospital, out-of-network doctor you didn't pick, you're responsible for $0. But you have to appeal it. Third one, you get a bill from a hospital, and it's legit. Don't do a monthly payment plan unless you have to. Here's what you do instead. Wait 60 to 90 days when you start getting the nasty notes. Then call the hospital up and say, look, I know I owe you $2,000. I don't want to do $500 down and $50 a month. It's a pain in the neck for everybody. Would you take $800 as payment in full? And then the hospital will come back and say, oh, no, absolutely not. We'll take $1,500 though. And it's let's make a deal, because hospitals will negotiate against themselves because they know if they give it to collections, they're going to lose 50%. It's going to take them 3 years before they're going to see their money.
Mm-hmm.
And more importantly, medical no longer counts against credit. So they used to ding your credit if you paid them less. Can't do that anymore. The law changed.
You mean like those ambulance bills for people? Those
Correct.
don't show up? Oh,
Correct.
interesting.
None of that counts against your credit anymore.
Okay.
Next thing to tell people about is GoodRx. GoodRx is Amazon for medications. If you need anything at a pharmacy, go on GoodRx, print up a free card, and bring it to the pharmacy and give them the card. You'll see 20, 30% discounts on a lot of stuff.
Wow.
And if you have a medication, put in the name of the medication, put in your zip code, and the system finds the 5 cheapest places to buy it. And it's not
Wow.
always the big box stores. And then the last thing we tell everybody is if you have prescription drugs that are generics, fill them at big box stores and ask one question. If I don't have insurance, what will this cost me? 95% of big box stores charge $5 for generic drugs. Well, if you have a $10 or $15 copay, or you have a high deductible plan where you're paying the contracted rate, it's cheaper to pay cash.
Yeah. Wow.
If it's not, then use your insurance. But those just kind of ways that you can save money on your existing plan. Doesn't matter the carrier, the plan, the network, none of that matters. These are all kind of things you should know about health insurance that you may not know.
All right. So I think we talked a little bit about when parties divorce and one moves out of state. Is there anything more that you would add to what we've already talked about?
No, that's really it. It's just really just be careful with the carrier, and you may be able to continue the coverage, but if you're moving to Florida and you have Blue Cross of Massachusetts, the coverage is pretty much useless
Right.
because there's no doctors.
All right.
Okay.
This comes
So
up
we
as a
do a
question.
lot of work
sometimes.
with, people have high deductible health insurance plans, and they have an HSA, which is a health savings account. So any money you put in to an HSA goes in pre-tax, is not a use it or lose it, rolls over until age 65, and you can use it for medical or medical related items. So glasses, dental, vision. So if you have money in an HSA and it's the end of the year and you want to use it to buy a new pair of glasses, fine. It goes in pre-tax, comes out tax-free as long as you use it for medical or medical related items.
Mm-hmm.
If you can't use it to go buy a TV at Best Buy, then it's taxable. But
Right.
if you use it for medical or medical related items, now the question of can divorced spouses access their benefits from an ex-spouse's plan? Yes. However, it is taxable income to that spouse.
Oh,
So
wow.
where it used to come out tax-free, if you get divorced and you're using let's say your wife and the husband has an HSA, okay, and you want to use that HSA money because you can, that's fine. You can use it, except it's not tax-free income. It's taxable income.
Hmm.
So you got to be very careful with an HSA or an FSA, because if it's ex-spouse's HSA, there's no joint HSA. So, you should set up your own HSA if you can, because you can access your own HSA tax-free. You cannot access your ex-spouse's HSA tax-free.
Mm-hmm.
So you got to just be careful with that.
All right. What about flexible spending accounts?
Same kind of thing. FSA money can go in pre-tax. You can roll over up to $640 of whatever you don't use. You can put in up to $2,500. You're allowed to roll over $640 in 2024. So it's not a use it or lose it anymore like it used to be. There is a portion of it that does roll over. But again, yes, you can use that money, but it's not tax. It doesn't come out tax-free like it would if you had your own FSA.
Okay. But while you're
that's
going
really
through the
key.
divorce, you should be able to use those things, the HSA and the FSA, assuming that the spouse isn't trying to block you from doing that.
Correct. But once you get divorced, then that money is taxable income to you, to the ex-spouse.
All right. All right. Life insurance. I know this is a big part of your practice.
Sure.
So tell us what we need to know.
Sure. So there's 3 types of policies. There's whole life, there's term, there's universal life. Easiest way to understand life insurance. Term is like rent. You pay a premium, it provides a death benefit, 10 years, 15 years, 20 years. And it's the most amount of coverage for the least amount of dollars. But term is like rent in that most people outlive their term insurance because they buy it when they're younger, they have kids, they need to cover a mortgage, things like that. But less than 2% of term ever pays off. In all the years I've been in business, which is, like I said, 43 years, I think I've paid 1 term insurance death benefit ever. So, but the advantage of term is the price. It's very inexpensive. And term insurance has gotten better with age because people think, oh, I'm 10 years older, it's going to cost me more money now to buy my life insurance. Term insurance, that's not actually all life insurance, but term especially, that's not the case because mortality than it was 10 years ago. So rates have actually dropped. Last year, 8 or 9 companies lowered their rate for term insurance. So what you should do with your term insurance is like anything else. You should review it often. It's, most people buy term insurance, they put it in the drawer, they're like, okay, I got life insurance, I'm all set. But there is one hole in term insurance that people don't think about. If your premium is late, the insurance company tells you. If your policy is going to terminate, the insurance company tells you. The one thing the insurance company will never tell you, when your guarantee period is ending. The reason they don't tell you that is because every single life insurance policy says the same thing. We will automatically renew you to the next highest rate. So what does that mean? All right, I got a $1 million term. I'm paying $100 a month. Comes out of my checking account the 15th of the month. I bought it 9 or 10 years ago. Great. We always tell our clients, go look at your actual or prospective clients, go look at your policy. Because term insurance is like music. You hear a song on the radio, you're like, that song's 20 years old? Well, that's term insurance. Most people think they know when they bought it, but when they actually look at it, it's never the same amount of years. And here's the problem. If you look at a term policy, $100 a month for 20 years, year 21, it goes to $3,000 a month. The insurance company will take $3,000 a month out of your account, not tell you, and you will not get your money back because it's happened. Because somewhere in the contract, it says they can do that, but nobody reads the contract. And that's why you have to be a little bit of an educated consumer and take a look at your policy, not the proposal, not, the actual contract itself, that'll tell you when your policy was issued. And especially if you have a Guardian, Northwestern, New York Life who push whole life, those are the 3 most expensive term policies there are. So they'll sell you term and say, well, you're going to convert to whole life anyway. Well, most people don't convert their term, and we don't recommend whole life. I'll explain why, especially when in divorce, why we don't recommend whole life. But with term, it's easy. What's your premium? What's your death benefit? How old is your policy? We're better, we're less expensive, we're not. You should always review your policies, because with rates coming down, and now with most carriers, it's simplified underwriting. It's 2-page online application, no exam, no blood, for about 65% of the people. Why we don't recommend whole life, especially in a divorce. Because the first thing that happens with whole life in a divorce is you got to cash in the policy because it's an asset.
Right.
Which means you lose the life insurance. So what we do instead is we tell people, look at what's called universal life. Universal life is like permanent term insurance. It's guaranteed death benefit forever, like whole life, but not designed to accumulate cash. So it's much less expensive. At younger ages, it's a quarter of the price. At older ages, it's about half the price. And then buy the universal life, keep the insurance, and then cash in the value of the whole life and split the money. We had a 38-year-old, for example, had a New York Life policy paying $800 a month, $100,000 of cash. They were going to cash in the policy, but the spouse said to me, well, but I don't get the life insurance then. And I said, well, look at universal life. Universal life at the same age was $300 a month instead of $8. Then they cashed in the policy. So they ended up with the life insurance for the spouse and the kids, and the cash split up evenly. So they ended up with the life insurance and the cash value instead of one or the other. They ended up with both, and they paid them about 1/3 of the price for it. So it was something that the ex-spouse could afford to contribute her share of it, and they ended up with both.
Excellent.
And
So,
that's why you tell people who have life insurance, you should review it. But if you have a whole life policy and you're getting divorced, don't cash it in the policy first. Look at a universal life policy where you can keep the life insurance, then cash in the policy, split up the asset.
that's very helpful, Jeff. So I'm just trying to remember if I've got your contact info. I don't think it was on that first slide.
Sure.
Can you tell us?
My name, again, it's Jeff Weiner, HKM Associates. I can be reached by cell phone at 516-316-1255. That's 516-316-1255. And I can be reached by email at jeff@hkmassociates.com. So if you have any questions or concerns, please feel free to give me a call, and I'll be happy to answer any questions and talk to you.
Well, Jeff, I want to thank you so much for your presentation. It was extremely helpful. And I think that brings us to the hour.
Terrific. Very
All
good.
right.
Thank you very much for your time. And again, if you have any questions, feel free to reach out by cell or by email.
Thanks, Jeff. Bye-bye
Okay.
now.
Take care.